When a war breaks out, most of us, we just see chaos, right? But for some of the world's biggest investors, it's more like a chessboard. And in this explainer, we're going to try to figure out their moves. Because believe me, when they start shifting trillions of dollars, you do not want to be on the wrong side of that trade. So let's dive in and see if we can find out where this so-called smart money is hiding. And that really brings us to the core question, doesn't it? Should you follow them? And this isn't just some, academic thought exercise. We're talking about so much capital moving that it creates these massive waves. Waves that can either totally capsize your portfolio or, if you play it right, carry it to whole new heights. So the real question is, how do we figure out which way that tide is turning? All right, first, let's just try to get our heads around the sheer scale of this. Look at this number. That's $13 trillion. That is how much money these state-owned investment funds are managing altogether. To put that into perspective for you, that is bigger than the entire economy of China. So we're not just talking about smart money here. No. This is market-moving, system-defining capital. Okay, so to even begin to understand their moves, we got to understand who they are. These funds, they operate in what I like to call the 13 trillion shadow. And from that shadow, they're influencing basically every financial asset on the planet. And a lot of the time, it's just an extension of their country's national strategy. So, what exactly is a sovereign wealth fund, or an SWF, as you'll hear it called? Well, to put it simply, it's just a giant pool of money that's owned by a country. You usually see them pop up in nations that have a ton of extra savings, often from selling natural resources like oil. And what do they do with all that cash? They invest it all over the world with the long-term goal of benefiting their own citizens. And believe me, some of these funds are just colossal. I mean, take a look at this. What's really wild here is the sheer size of the one at the top. That's Norway. Their fund, which they built out from all their oil wealth, is the single biggest one out there, a staggering $1.8 trillion. To give you some context, that means they own over 1.5% of every single publicly traded company in the world. Yeah, we're definitely going to be keeping a close eye on their moves a little later. And you've got to understand, these aren't just giant hedge funds trying to make a quick buck every quarter. Not at all. Their goals are way bigger. They're strategic. They're national. They might be trying to stabilize their own economy when things get rough. Or look at Saudi Arabia's PIF. They're pouring money into these massive giga projects to try and move their economy away from oil. Norway's fund? It's so huge that its investment returns actually cover 20% of the entire government's budget. And then you have China, which uses its fund to project political power through things like the Belt and Road Initiative. So, you might be asking, why are we talking about this right now? Well, it's because when a big geopolitical crisis hits, these funds don't just react to it. Their actions can actually define the new reality for every single investor out there. So let's take a look at how this whole chain reaction gets started. This is a perfect illustration of the domino effect, right? A conflict kicks off in one region, especially one that's critical for commodities like the Middle East, and it just doesn't stay there. It immediately sends out a shockwave. The oil supply gets threatened, and honestly, just the threat of that is enough to send prices through the roof. And that leads to consequences for everyone, everywhere. Higher shipping costs, rising inflation, and something that's way more dangerous. And hey, this isn't just some abstract theory. A senior portfolio manager over at Neuberger Berman said it flat out: if a key shipping lane gets disrupted for more than a month, you can bet oil prices are going well into the triple digits. We really haven't seen that happen in a sustained way since 2022. And let me tell you, the economic fallout would be immediate and it would be severe for all of us. And that brings us to this really crucial idea: systemic risk. See, this isn't about one company going belly up. Nope. This is the risk that the entire system, we're talking the S&P 500, the thing your 401k is probably tied to, comes under massive pressure. When global trade gets all messed up, the risk of a total market collapse goes up for every single one of us. Okay, so if these funds are so powerful, how in the world can we know what they're up to? Well, it's actually kind of like being a financial detective. The thing is, they're so huge, they can't really hide their moves. Plus, they actually have to disclose some of what they're doing in public reports. You just have to know where to look for the clues. I absolutely love this analogy. Think about it. How do you track an aircraft carrier? You can't just use a pair of binoculars, right? It's way too big, way too powerful. But that exact size means it leaves this gigantic wake behind it. It moves slowly, deliberately, and because of that, its movements are totally detectable, if you know what you're looking for. Well, sovereign wealth funds, they're the aircraft carriers of the financial world. So what's in our detective kit? Well, for starters, there are public filings. In the US, any big fund has to report its holdings every quarter in something called a 13F filing. Now, yeah, it's looking backwards, but it shows us where they've built up a huge position. Some analysts even call this an institutional floor under a stock's price. Next up, their annual reports. And funds like Norway's are incredibly transparent. They don't just tell you what they own, they tell you why they own it. That gives us a direct peek into their long-term thinking. You start piecing these clues together, and suddenly, the outline of their grand strategy starts to take shape.
And this part is so important. The goal here is not to copy them trade for trade. You and I, we just can't operate like a multi-trillion-dollar fund. It's impossible. The real value, the real alpha, is in understanding the big macro-level themes they're betting on for the long haul. Where are they putting their capital for the next decade? That's what tells us where they think the world is headed.
Okay, which brings us to the moment you've been waiting for, the big reveal. In this whole environment of conflict and uncertainty, where are these giant aircraft carriers steering all that capital? I'll give you a hint. The answer might surprise you. It's probably not where you're thinking. Traditionally, when the markets get choppy, investors run for cover in so-called safe havens. You know the drill: gold, government bonds. But these SWFs, they're playing a totally different game. They're moving into what I'd call smart havens. See, they're not just playing defense, they're on offense, strategically positioning for the future. And that means they're buying up essential, hard-to-replicate stuff. Things like strategic infrastructure, energy assets that everyone else is ignoring, and the picks and shovels that make the modern economy actually run. So what does that actually look like in practice? Well, it's a strategy that's deeply counterintuitive. They actively hunt for what some might call defective companies. Basically, businesses in controversial sectors that other investors won't touch. And they love to invest during times of mass pessimism, when everyone else is panicking. Why? Because their goal is to buy real valuable assets for pennies on the dollar. I mean, think about a big oil company that gets totally hammered by the market because everyone's focused on green energy, even though we all know global oil demand isn't disappearing for decades. That's the kind of pessimism these funds just love to exploit, letting them build huge positions for cheap. And this whole picks and shovels idea? It is absolutely brilliant. I mean, forget about the flashy AI software company for a second. The really smart money is buying the companies that provide the essential, non-negotiable plumbing for it. For instance, Norway's fund just recently upped its stake in companies that handle thermal management for data centers, think Vertiv, and high-speed networking gear from places like Arista Networks. And why would they do that? Simple. AI needs a truly staggering amount of power and cooling to work. It's the boring but vital stuff that makes all the exciting stuff even possible.
All right, so this all sounds amazing, right? We know who they are, we've got some ideas on how to track them, and we see where they're headed. So we should just copy them, right? Well, not so fast. This is where we get to the most important and, frankly, the most brutal truth of this entire deep dive. Let's circle back to that central analogy we were using. An SWF is an aircraft carrier. You're a speedboat. You are nimble, you are fast, you can change direction on a dime. The aircraft carrier cannot. And this massive difference in agility, well, it's everything, because it reflects a fundamental difference in something even more important: time. Just take a look at this timeline. A day trader is thinking in minutes or hours. A typical retail investor, maybe you might have a 1 to 5 year horizon for a specific investment. But a sovereign wealth fund? Oh, they are literally investing for the next generation. Their time horizon isn't 5 years, it's 50 or more. This is the purest form of patient capital you will ever see. Benjamin Graham, the guy who basically invented value investing, he said it best. He said an investor has to be prepared for all the market's ups and downs, not just with their money, but in their mind, psychologically. So ask yourself, could you watch one of your investments go absolutely nowhere or even lose money for 5 years straight without totally losing your nerve? An SWF can. Most of us can't. And here it is, the brutal truth. What might be a brilliant, winning trade for a fund that can wait 50 years could be an absolute portfolio killer for you. See, they could afford to buy something and just wait, a whole decade even, for their idea to play out. But for a retail investor, that's a decade of dead money. That's massive opportunity cost. And that, my friends, is the very definition of bag holding, being stuck with a dud while much better opportunities just pass you by. So what's the big takeaway here? Look,
Tracking these massive funds is an incredibly powerful tool. It really is. It can show you the long-term tectonic shifts happening in the global economy. It can point you toward the final destination. But, and this is a big but, it is not a shortcut. You still have to navigate the journey yourself, on your own timeline and with your own stomach for risk. So the ultimate question isn't just where is the smart money going? It's can you actually survive the long and often very bumpy road to get there?